what in equities, Ridham? I mean, there are two cycles operating right now. One is consumption, which is trading at premium valuations compared to the rest of the market and still finding favor. And there is the butchered out lot, which continues to languish. Though, of course, there has been a bit of a bounce back from those abnormal lows, but still not finding too many takers. Where are you finding favor on this bullish stance of yours for the next 12 months?
See, I'll break up the macro cycle into 4 parts. Okay. So we have discretionary consumption, which I think is in good shape, and I don't see any reason why that's actually going to suffer. In fact, if rates come off, as I expect they will, it will actually help discretionary consumption. There are a lot of structural trends in discretionary consumption. So there are shifts happening, category shifts, as I call them, and a lot of stocks and sectors will benefit from those category shifts. So consumption in this country has always been high, right? But it is primarily in very basic stuff like food, shelter and clothing. As the country becomes more opulent, as income levels rise and as wealth rises, we'll see category shifts. We'll move out of food, clothing, shelter into other categories. So we see discretionary consumption, discretionary services gaining more share. So I'm bullish on things like entertainment, media, autos, most of these areas of discretionary consumption, especially in urban India. I think rural India is going through a soft patch cyclically because I think the government has pulled back on spending, and rural India has suffered a negative terms of trade, which is that food prices are now rising more slowly than before, and therefore they're suffering from a negative terms of trade, which I think is the opposite for urban India. So one theme is urban consumption. So you need to be positioned in urban consumption. Then the second part of consumption is staples, the so-called staples. Now a lot of those stocks are actually quite rich in terms of valuations. So no doubt their fundamentals are very good, but the valuations are not appealing enough. And in the end, when you're investing, you have to pay cognizance to both fundamentals as well as valuations. So where the staple stocks don't make the cut is that they are already pricing in the good story. So I avoid that basket. On the other side is your investment story. Now again, investments are 2 parts. One is the manufacturing capex and the other is the infrastructure capex. I would argue that there is still some time for manufacturing capex to recover, and let me pause and explain that. The reason I'm saying is that between 03 and 08 corporate balance sheets in India expanded enormously. We had a 30% CAGR in asset growth. A lot of capacity got created. Then we got the financial shock of 2008, and since then growth has been relatively tepid. So utilization rates, which fell in 08, have still not recovered to levels where a capex cycle gets triggered. We actually do this in terms of asset turn. So the asset turn, which is the rate at which you turn over your assets, is still 30% below the average of the last 10 years. Now, unless that normalizes, we will not get a big manufacturing capex cycle. So in my view, that's a sector you want to avoid. So that's generally your capital good companies. Having said that, I still think that infrastructure will behave a little differently because arguably there is a shortage of infrastructure in the country, and infrastructure has been, I think, hurt because of policy lacunae. A lot of those things should start getting fixed in the next 12 months. So I think a recovery in infrastructure capex will happen. So within capex, I think there are 2 parts. So I wouldn't mind actually buying a bit of infrastructure capex and discretionary consumption. And then one sector which doesn't fall in the discussion of India's macro is technology, which falls in the discussion of global macro. I think the global macro is wonderfully set up for Indian tech companies. It is not very dissimilar, though I would not draw that parallel, so don't misunderstand me, but it's not dissimilar to 1999. Tech spending, I think, is set to rise considerably in the next 2-3 years.
Because it hasn't happened till now.
In the last 4 years, there's been very little tech spending. Also, we're getting some new trends in technology, like cloud computing, like social networking. The need to outsource, I think, is a lot more than it has been for the last 4-5 years, because corporate America, corporate Europe need to protect profitability in an environment where growth is likely to remain sluggish. So they need to cut costs. So I think Indian companies have a very good environment. And if you look at the stocks, they're not pricing in this in. They're relatively cheap compared to where they have been in the last 5-7 years. So that's the sector you want to buy. So I think that's how a portfolio can be constructed. A bit of infrastructure, real estate, a lot of discretionary consumption, and a fair bit of technology.
Would you, I mean, I know you can't speak stocks, but would you segregate amongst the IT companies, or do you believe that the basket as a whole, because of business models being, I mean, broadly being similar, all of them would broadly benefit, and there will be a couple of them which will do business much better and therefore benefit more?
Actually, we like both mid-cap and large caps. The mid-caps offer more value. They don't offer the obvious advantages of scale and balance sheet. The large caps bring those on the table. So we like, actually, I think in a portfolio you can have both. So I'm not distinguishing too much between large and mid, large and small, or large and mid. I think both the subsectors have merit in investment.
But IT as a whole, the entire theme, you believe the basket would benefit broadly. Okay, the other bit is on infrastructure, and it's a wide basket again. I mean, there is road construction companies, there are companies which are operating in the port area, so on and so forth, and there are companies which cater to certain large areas like power as well. What within the infra space do you find favorite?
I think infrastructure, generally speaking, is looking good value at these levels. So I'm not distinguishing between these various aspects of infrastructure. I think the utilities, if you're mixing it up with the utilities, those I think are avoidable. Okay, because I think there are some big problems there with respect to the PPAs and with respect to coal supply. So I think those are probably avoidable. But companies that are engaged in construction of power plants are okay. I mean, those I think should do well. But companies that are engaged in construction of roads, I think look quite good. So I'm more interested in the companies that are building infrastructure rather than operating infrastructure. So I think utilities are operating power plants. So those are less attractive to me. What I'm interested in is the guys who are actually building the stuff, because really the juice is in the guys who are building it, and that's where I think there could be momentum coming back. And
the interest rate cut cycle, if it does come about, adds that bit of vigor to some of these road construction companies.
That helps both actually, but that helps the owners more than the builders.
Sure.
So the owners, they are the ones who finance projects. So the owners of infrastructure benefit more.
But you're not playing it because of the interest rate cut theme?
No, I'm not playing it for that. I'm not playing it for that. I think the rate sensitive you want to buy is discretionary urban consumption. Rather than sorry?
Not banks.
Banks, we are actually still underweight on banks, but I distinguish there between public and private sector. So I think we still like the private sector banks. So I think you can buy private sector banks, but I think the public sector banks still have to go through a little bit of pain on the NPLs front. So that needs to actually turn around for them. So maybe it's a little too early to go into them. The stocks have done very well, so I think they probably want to be avoided right now.